Welcome back to the deep dive. Today we're looking at corporate performance when things, well, don't quite go according to plan. Specifically, we're digging into the Q1 fiscal 2026 earnings call for Prestige Consumer Healthcare. You probably know their brands better: Clear Eyes, Summer's Eve, Dramamine, things like that.
Yeah, and this call was, let's just say it had some drama. The market reaction was fast and pretty negative. So our job today is basically to figure out why the stock dropped 10% right after the call, and also critically to look at this big $100 million plan they announced to try and fix things and get growth back on track.
Right. It feels like a story about, dropping the ball operationally, but then making a big strategic play to recover if they can pull it off.
Exactly. Execution is key now.
Okay, so let's start with those headlines because they really tell you why the market flinched. The top line, the revenue, it's a big miss. They reported $249.5 million for Q1. The consensus, what analysts expected, was closer to $260.7 million. That's a year-over-year drop of 6.6%. Ouch.
Yeah, ouch is right. And it wasn't just revenue. Their GAAP EPS, the official earnings per share, also missed. $1.95 versus the $1 in El Paso. So you see those numbers and the market immediately thinks risk, problems here. Hence the 10% haircut on the stock price.
But, and this is where it gets interesting, right? Despite those misses, there was another side to the story they were telling.
There absolutely was. They tried to weave this counter narrative focusing on financial strength despite the sales mess.
How does that even work? Miss revenue, but still have good news?
Well, because the quality of the earnings underneath the hood was actually pretty decent. Their adjusted EPS, which strips out some items, was actually up about 6% compared to last year, mostly because they managed their costs well, controlled margins. And maybe the biggest point, record Q1 free cash flow, $78 million.
Okay, free cash flow, FCF. Remind us why that's so important, especially when revenue is down.
Right, so FCF is basically the cash the company actually generates after it pays for everything it needs to keep the business running: buildings, machines, basic operations. It's the free cash left over for things like paying down debt, maybe buying back stock, or making acquisitions like the one they just announced. The fact that their FCF was strong, and importantly, they didn't cut their full-year FCF guidance, that's what kept the stock from maybe falling even further. It signals the core business is still profitable, even if they had trouble, getting product out the door.
Profitability intact, shipping failed. Okay, that tees up the core problem perfectly. Let's unpack that. What exactly went wrong with shipping? Why the shortfall?
It really boils down to one critical area: eye care. Specifically, their huge brand, Clear Eyes. Management was pretty direct about it. They had supply chain problems because of a planned shutdown at their main supplier back in May. And that shutdown it went on longer than they expected.
And Clear Eyes isn't just some small part of their business, is it?
Oh, not at all. It's massive. Clear Eyes is the #1 brand in redness relief by volume. They sell something like nearly 50 million units a year.
Yeah.
It's a high-margin workhorse for them. So when production stops unexpectedly, you can't fill orders. And they said they lost distribution for key products like the Cooling Comfort and Complete Care lines during their peak season, May, June, July. That's lost share, lost shelf space.
And that failure, that bottleneck, forced them to completely reset their expectations for the entire year. The guidance change was drastic.
It really was. They went from forecasting positive organic revenue growth, like 1% to 2%, to now expecting negative 1.5% to 3.0% growth for fiscal 26. That kind of swing from positive to significantly negative is exactly what shakes investor confidence, especially in consumer staples, where people expect stability.
Did they break down why the guidance had to drop so much? Was it all the Clear Eyes issue?
Mostly, yeah. They said about 60% of that negative swing in the forecast is directly because of the eye care supply problems. The other 40% they attributed to just general volatility in retailer orders right now. Big swings week to week that don't seem tied to actual consumer buying patterns. They were careful, though, to say it's not because retailers are sitting on too much inventory. It's more about ordering patterns being unpredictable lately. Okay, so faced with this mess, management didn't just explain it. They also announced a really big kind of defensive move, right? The Pillar5 acquisition.
Exactly. This is the pivot point. They announced they're buying Pillar5 Pharma, which was actually their main supplier for Clear Eyes based in Canada, for about $100 million in cash.
So they're basically bringing manufacturing in-house for this critical product. That's the logic. They realized relying on an outside supplier was too risky for such a core product. So yeah, bring that sterile eye drop making capability inside. It gives them control and Crucially, they think it will let them expand capacity faster. They mentioned a new high-speed production line that should be running by their fiscal third quarter of 26.
But wait a second. Spending $100 million to buy your supplier, doesn't that kind of admit that maybe your previous supply chain strategy wasn't great? Does it raise questions about, how they managed things before?
Look, it absolutely raises questions about past oversight, no doubt. But often, the market rewards companies for taking decisive action once a problem is clear. Think of it like extensive insurance. They're betting $100 million now to avoid potentially bigger losses from future supply shocks. The deal should close in Q3, and they said it should be neutral to EPS and their debt levels, initially at least.
Leverage neutral, meaning it won't mess up their debt situation too much.
Right. It means the deal isn't expected to significantly increase their debt relative to their earnings. PBH actually has a pretty good reputation for keeping debt low. Their leverage ratio is currently around 2.4 times earnings. So this purchase, while significant, doesn't seem likely to strain their balance sheet or stop them from continuing to pay down debt.
That strong balance sheet, that focus on debt, it seems like the bedrock here, especially when you also look at their gross margin story. Revenue down, but margins up.
Yeah, that was the other key part of the counter-narrative. Gross margin actually expanded by 1.5 percentage points, 150 basis points year over year, hitting 56.2%. In the consumer goods world, improving margins like that, especially when sales are down, is a big win. They credited cost savings programs and selling a better mix of products, and even with the lower revenue forecast, they're still aiming for a full-year gross margin of 56.5%.
So that margin strength plus the solid FCF, that's what gives them the room to make this $100 million Pillar 5 bet. It shows they can manage the underlying profitability.
Precisely. And one more bright spot we should mention, their international business. While North America struggled with supply, the international side grew organically by 7.1%. That's actually better than their long-term target of 5% plus. It shows the brands are healthy and in demand outside the U.S.
So if you pull all this together, it feels like a real shift for the company. Prestige used to be known more as a roll-up company, right? Buying brands, running them efficiently.
That was the playbook for years, yeah. Disciplined acquirer. But now, the story is pivoting hard towards supply chain hardening. They're focused on protecting their biggest, most profitable assets from operational risks. This call wasn't about the next deal. It was about shoring up the current foundation.
And that foundation is what their whole recovery story rests on. Management is talking about a more meaningful recovery starting in the second half of their fiscal year 26, running into 27. So not an overnight fix.
Definitely not. And that recovery depends on a few things happening just right. They needed 2 new third-party suppliers to ramp up. One started in Q1, the next should be Q3. And, most importantly, they need that Pillar 5 integration to go smoothly and quickly in Q3. They even warned investors that getting back all the lost market share and distribution, that's going to take more than just 1 or 2 quarters.
Which brings us back to that 10% stock drop. It really suggests the market is thinking, okay, we hear you say recovery is coming in the second half, but we're skeptical. Management's credibility seems totally tied to executing this Pillar 5 integration now.
Absolutely. So for anyone watching this company, there are basically 3 key things, catalysts to monitor. 1, how does the Pillar 5 deal progress? Does it close on time in Q3? Any hiccups? 2, tangible proof. We need to see evidence in the Q2 and Q3 shipping numbers that the Clear Eyes supply is actually recovering. Are fill rates improving? And 3, can that strong international growth continue? And can women's health, like Summer's Eve, keep its momentum to help offset the North American issues?
Until we see positive signs on those fronts, the stock might just stay stuck near these lows, reflecting that skepticism. Okay, let's shift gears for our final segment. This is where we talk about an outrageous but plausible trade idea based on everything we've just discussed. And remember, this is purely for entertainment, for discussion. Definitely not financial advice.
Right. So the setup here is pretty straightforward. PBH has this known critical supply problem that led to a really ugly guidance cut. The stock got hammered for it, trading near its lows, even while the broader consumer staples sector, like the XLP index, has been kind of flat. That creates a potential dislocation.
But the counter-argument, as we've discussed, is that the underlying business isn't broken. Balance sheet is strong, FCF is solid, and they're making a very direct, if expensive, move to fix the exact problem the market punished them for.
Exactly. So the trade idea is kind of a multi-part bullish strategy designed to play the long game while acknowledging the short-term pain. Step 1, you could initiate a long position in PBH shares now. You're betting that the strong FCF yield and the strategic logic of securing supply with Pillar 5 will win out eventually.
But Q2 earnings might still be rough given the lingering supply issues, right? So you need some protection.
You do. So, step 2, hedge that immediate risk. You could sell a near-term put option, maybe one that expires right after the Q2 earnings are released. Selling a put means you collect cash, the premium, upfront. It lowers your cost basis on the shares, and you essentially get paid to bet the stock won't fall much further from these already depressed levels in the very short term.
Okay, so you own the stock, you've hedged the immediate downside, then comes the bet on the actual recovery.
That's step 3. Simultaneously, you buy a call option that expires further out, say, in fiscal Q4 of 2026. This call option is your explicit bet that the Pillar 5 deal will close in Q3, that the supply recovery will start showing up in the second half numbers, and that management will regain credibility, causing the stock to rebound. The whole idea is trying to capture that dislocated value. The market seems overly focused on the revenue miss right now, potentially underweighting the solid FCF and the strategic fix they're putting in place. So summing up our deep dive today, prestige consumer healthcare has shifted its focus. It's less about buying new brands now, more about making its core supply chain resilient. They're making a big, costly bet on the Pillar 5 acquisition to secure their high-margin Clear Eyes business. The strategy makes sense on paper, but everything now hinges on whether they can actually execute over the next 6 months and prove that second-half recovery is real.
Thanks for walking us through all that. It's a complex situation. For you listening, keep a close watch on those catalysts we mentioned, the Pillar 5 deal updates, and especially any hard data on Clear Eyes shipments getting back to normal. That's really where the story for PBH will turn next.